Well, hello everybody. I'm Bill Bush with Horizon Financial Group, and thanks for joining us today for our presentation, Three Emotional Pitfalls in Long-Term Equity Investing. So the purpose of this exercise today is to begin a conversation around this critical idea. Equity investing is overwhelmingly an issue of temperament. So simply stated, what the market does is often far less important than how we react to what it's doing, or, if we even choose to react at all. It's about temperament, emotions, behavior. Morgan Housel put it this way in his book, The Psychology of Money, which I read about 3 or 4 years ago, and its quote goes something like this. Financial success is not a hard science, it's a soft skill where how you behave is more important than what you know, unquote. So put that another way, behavior trumps knowledge. Now, ideally, the long-term equity investor would stay just even keel when it comes to good times and bad times. But of course, that's way much easier said than done because emotions and feelings are involved. So the thing about that is we're going to look at 3 very natural human instincts that act against investment success. And these 3 pitfalls, we'll call them, share these characteristics. So number 1, know that these feelings are natural and instinctive. So if you have them, and you have, or you probably will, don't think, something's out of the ordinary. Don't think something crazy's happening. 2, they're universal. We all have them. Yes, everybody. It's just part of being human. And then 3, I think, but acting on these impulses is most often harmful to long-term returns. The wrong reaction at the wrong time can derail, the best of plans. So let's dive in with emotional pitfall number 1. And yeah, this one stands out. Market losses feel twice as bad as market gains feel good. That one definitely hits. So think about your portfolio. If your portfolio had a gain of, say, 30% over some time, maybe the last year and a half, which may not be unreasonable, that probably just felt okay. You might think something like, well, that's what it was supposed to do. It's supposed to do that, isn't it? Some version of that type of thought. You wouldn't probably get very excited about it. You wouldn't go out in the street and yell, I got 30% return, I can't believe it. You kind of expect it, right? But what if your portfolio had a decline of 30%, which, by the way, the S&P 500 has done that about every 5 years or so on average? Well, that decline feels like an existential crisis. You can't help but think, my retirement nest egg, is being destroyed. There goes my future. Well, it's important to note that this is an unconscious choice we're making, attaching very different emotional weights to the same percentage change, which, 30% in the instances I mentioned. And there's some psychology behind that. And psychologists Daniel Kahneman and Amos Tversky, they first identified and studied loss aversion back in the 70s. And their work helped establish loss aversion as a key concept in what, is known as behavioral economics. Kahneman, he won a Nobel Prize in economic sciences for this work, which kind of became known as prospect theory. So it's all around the notion that losses feel way worse than the gains feel good. Emotional pitfall number 2 is next, and it goes like this. In most aspects of life, we experience lower prices as good. That's a good thing. In investing, though, we experience lower prices as bad. This is a big concept here. Again, it's instinctive, it's natural, it's virtually, universal. And again, acting on this feeling most often leads to long-term regret. We can state this, another way. In everything else, lower prices signal increasing value. So think of that. If this shirt was $40 last week and now it's down to $30, the price decreased. Whoa, what a deal, Even the price of a bottled Coke, $2.75. But hey, They got them today, 2 for $4. What a value. You know, you'd feel good about that buy, wouldn't you? Well, when it comes to investing, you know, it's the other way around. You know, we feel good about paying more and more than we should feel better about, you know, when things go on sale. And historically, by the way, all major market declines, they've proven to be big sales. Now, there can be no guarantees, of course, but great quote here, the stock market is the only market where things go on sale and all the customers run out of the store, a quote from Colin Roche, a financial journalist. So historically, a bear market has been a big sale of shares of good businesses. But most people, they don't run for the sale, right? No. Instead, they run out of the store. And, you know, running out of the store isn't rational from the sense of essentially running from value, but it is, like we mentioned, instinctive. And so that's kind of the whole point. Instincts of this presentation, you know, instincts, emotions, behaviors are strong forces, but how can you even overcome things like instincts? Well, let's reframe things just a bit and see if this helps. So instead of stocks, let's call them companies. And instead of investors, well, let's call them owners. After all, when one invests in stocks, what are they really doing? They are buying small slivers, small portions of companies. Buying, they in effect become owners. Owners of what? Companies. And that's really what equity investing really is all about. So, companies, owners, does that make you think any different? Instead of calling ourselves investors in stocks, we could call ourselves owners of companies. Now, each contribution, maybe to your 401k or an IRA, or buying very small slivers of companies. You've paid for them, you own them, so hello, my fellow company owners. It hits a little different, you know, from the phrase investing in the stock market. That sounds very institutional, or playing the stock market, doesn't it? It just sounds different. But not only does it sound different, probably feels a little better too. Consider these phrases right here. So one is the stock market. And the second one is 500 of the largest, most profitable, best managed, and most innovative companies in America. Okay, note the different emotional effect of the second phrase compared to the first. The words themselves, largest, profitable, best, innovative. They land in a better emotional place, at least in my mind for sure, than definitely the phrase the stock market. So let's expand on that just a bit. And I want you to think about these 3 questions coming up. What company is the largest retailer in the world? You can chime in on the chat if you'd like, but think about that. The largest retailer in the world, that's the first question. And then we'll follow up with this one. What is the largest bank in the U.S.? And we're talking about more branches than any other. And then thirdly, what is the largest hotel operator in the world? And we're looking by number of rooms here. So we do have a Walmart answer, and that is what we're going with. Walmart, the bank, JP Morgan Chase, Marriott. We think of them as what they are, as stocks, or do we think of them more in terms of seasoned, successful companies? So the next time the S&P has a significant dip or downturn, I invite you to turn off CNBC and just take a ride to the local Walmart and see if that superstore is still open, or whether, the local Chase Bank still seems to have people going in and out, or drive by the Courtyard Marriott and see if it has its doors still open. If they look pretty okay, maybe trying to tell you something. And here's the thing. So the more we can think of stocks as substantial companies, the more we can accept that, at least historically, lower prices have always signaled better value. And that leads the thinking that from time to time, I will be able to buy into more ownership of these companies at lower prices, and that's value. So a few points to get to right now. None of this is a prediction. None of this is a recommendation to buy any particular stock or own any particular company or all 500 of them that happen to be in the S&P 500. It is, getting back to the emotion and the behavior, simply a plea to try to resist the very human impulse to run out of the store. And here's why. So by not running out of the store, it's likely you'll eventually experience some tailwinds and some pretty decent ones that will propel you forward. And often those tailwinds happen near downturns. This stat, consider this one. S&P 500 in the last 20 years, 7 of the best 10 days in the S&P 500 occurred within 2 weeks of the 10 worst days. 7 of the best, very close to 10 of the worst days. So if you would have run out of the store on any one of those bad days, you'd have missed some very good days likely. And missing those days, one could argue you've actually created a self-created headwind in that situation. So let's go back and think about in your lifetime. So let's go back, not even really 20 years ago. How about the financial crisis of 2008 and 2009? How low did the S&P 500 go back then? That would have been easily, of course, in our lifetime. Anyone remember what it was then? You can put in the chat if you would like, but I'm about to have the spoiler alert right here. It was way, way lower than what it is now. The S&P 500 went to 677. We're looking for the number of what the index was, although somebody did put, negative 47% was rocked, right? 677. What about, so that was obviously the global financial crisis. The world credit system practically ceased to exist for a while. But now let's do the early 2020 COVID-19 pandemic. World economy shut down. Anyone remember the low there? During how low did it go? And probably would have been in March 2020, where every company stock was rocked pretty much. And that answer is, drum roll, 2237. And it was actually up, if I recall, up around 3,400 practically before that, and pretty significant drop down to 2237. That wasn't even really 5 years ago, a little less than 5 years ago. But then, where is the S&P 500 index now? You could probably look on your phone and get the update, and it's probably 60, 80 or somewhere around there. It's been hovering in the 6,050 mark. So, wow, I mean, that's a 2.7 times growth, in less than 5 years. The point is that, both of those crises passed, superior companies, resumed being superior companies, growing their earnings and dividends over time, and leading the S&P 500 to where it is now, 2.7, 2.8 times higher than less than 5 years. The largest, the innovative, the profitable, the best managed companies figured it out, and other ones came along the way. So now, emotional pitfall number 3, as markets fall and fear rises, it's only human, we lose the ability to distinguish between temporary decline and permanent loss. We lose the ability to distinguish between temporary decline and then a permanent loss. And so the thought here is, the market is down, I lost money. Well, the account value certainly may temporarily have gone down, but did you really lose money? And we'd almost wouldn't be human if we didn't feel this way. But, feeling it and acting on it are a couple of different things. And, helping clients not give in to that, I think, is probably the most critical job of an advisor. I certainly heard it many times, especially in 2020. The market's down, I lost money. We actually didn't lose anything unless, of course, you took some action on that emotion and sold, some of the holdings and maybe locked in what would be a loss then. But of course you say, this time it's different. I know it's different this time. It's not gonna go back to what it was. And this is a quote from one of the great investors here and philanthropists too, by the way, Sir John Templeton, who says, the 4 most dangerous words in investing are, this time it's different. And I'll say all crises are significantly different from others in history, and I don't think that's what he's saying here. But what he's getting at is they've never yet been different where it really counts. So what could have been more different than the global financial crisis? The world's banking system melting down over the subprime mortgages on American single-family homes. That's very different. How about the world's economy locking down during COVID? Totally different. But again, where are the values of superior companies now versus where they were then? And that to me is kind of what Templeton is always trying to tell us here. It's not different in the sense that well-managed, innovative companies run by some of the brightest people in the world, they figure it out. New companies emerged, adapted, these companies rebounded, continued forward in a positive direction. And owning those companies over time has worked out for the best. So hopefully this has made you think a bit and made you realize when it comes to long-term equity investing that emotions, thoughts, certain types of behavior, natural and instinctive, but it doesn't mean you have to act on them. And we kind of have a saying around here, and it is, don't worry alone. Especially about something as important as your long-term livelihood, future retirement. We always say we invite you to worry with us. And we'd be glad to certainly visit with you about your situation if you'd like. And we'll tell you how to do that, in just a second. So if you want to continue the conversation and talk about your emotions and how it's affecting your outlook on investing, certainly we would be glad to visit with you. To do that, you can do it in a couple of ways. You can go to our website, horizonfg.com/contact. Fill out the form there. We'll set up an in-person meeting with one of our advisors and, just have that conversation and see where you are. And then the other way is you could email us at info@horizonfg.com. Again, thanks for being a part today. And that'll wrap things up. We will see you soon, hopefully. Again, thanks a lot, and we'll see you.